So our first speaker is Dale Branham. Dale's been in the mortgage business for 26 years, where he has held several senior positions. Dale has spent the last 3 years with Wells Fargo Home Mortgage. Dale is a Wright State University graduate, where he graduated cum laude. Dale is currently the Senior Vice President of Planning and Capital Management at Wells Fargo Home Mortgage. Dale's responsibilities at Wells Fargo include financial and strategic initiatives for the mortgage company, including the budgeting, forecasting, reporting, analysis of financial results. Dale, if you could stick around after your presentation, I'd like to speak to you about my pending foreclosure on my home. But anyways, please help me welcome Dale Branham.
Thanks, Matt. I do appreciate the opportunity to discuss the housing market with you today. As Matt mentioned, I've been with Wells Fargo Home Mortgage now for 3 years. I am an Iowan now for 3 years, meaning my wife and I moved to Iowa in March of 2009. I moved into the state, fine state, March the 12th, began working March the 13th. I say that only because of some things that I learned over the first year of my residency here in Iowa. I learned that if you live here long enough, or at least sometime in that first year, sometimes people begin to think illogically or irrationally. Things just aren't syncing up. The dots aren't connected. Some of the things they say don't necessarily make all the sense in the world. And I say that because in December of 2009, my wife began questioning the sanity of my decision to take a good job with a great company of Wells Fargo Home Mortgage in moving here into the fine state of Iowa. And she was questioning that decision because of all things, the weather. It's like, now how logical is that? I mean, the weather, that was a rough winter, but come on, let's get real here. So 2 years later now, her sanity and her logical, rational thought process has been restored, and everything's good. We're moving on. I think we've made it over the hump, and that little rough, tumultuous time of 2009 is behind us now. So hopefully it's onward and upward from here. I do have one disclosure to make before we dive into the materials. That being, I am not an economist. As Matt mentioned, I'm a mortgage banker, longtime mortgage banker with a financial background. Having said that, what that means is I view the world through that lens. That may be good, that may be bad, but I do know it's different than an economist would. It's probably different than you would. It's probably different than my team members would view the world. But I give that disclaimer up front. I may connect dots a little bit differently than you may. I thought about having a theme. You know, themes are usually good for presentations. They kind of keep things flowing. I decided not to have a theme for the presentation today, but I did want to cut to the chase and at least provide you some advance insight that if I were to have a theme, what would it be? It simply stated would be thankful you live in Iowa. Sounds very simple and straightforward. Be thankful you live in Iowa. I may use that phrase from time to time. I'm not going to elaborate further on it now, other than to say, hopefully you'll be able to piece things together as we progress to the presentation. And by the time we get to the end of the presentation, I hope it'll resonate and make a little bit more sense as to why that would have been my theme if I were going with a theme dimension for the presentation. Having said that, maybe I'll give you a little color and perspective about what I'm going to discuss with you here over the next 15 to 20 minutes. We're going to talk a little bit about the economic environment, talk a little bit about the mortgage markets. Hopefully that sets the table nicely for a review of the housing market, and finish up. Hopefully we'll have a little bit of time for Q&A at the end, so you can be thinking if there's questions along the way that you want to ask. I did bring some subject matter experts with me, and I'm told that we're positioned to answer most any question that you might have for us. Let's go ahead and dive into some of the discussion. First, starting with the economic environment. What would be a discussion of the economic environment without talking about employment, or in this case, unemployment? As you can see, everyone knows national unemployment peaked back in September of 2009 at about 10%. And we've been slowly grinding our way back to lower and lower rates of unemployment since then. Our last posting was 8.3% over the last, I guess it just came out a week or two ago, the 8.3% posting for January. What would somewhat mute anyone's optimism in terms of interpreting this data would be the fact that what's outside of an unemployment rate would be the underemployed, where we have a lot of people that have taken positions and are earning less than their capabilities would warrant or indicate. And then we also have the workforce withdrawals that have occurred and where people have removed themselves entirely from the workforce. So you have those two dimensions going on. So bottom line is, relative to unemployment, it's probably going to be a long road to hoe. Don't have great expectations in terms of significant improvements in unemployment, but it should be a slow, steady grind. Here's our first of many. Be thankful you live in Iowa. If you look at the Iowa Des Moines unemployment rate trend, you can see it looks very positive relative to the national trend line. And I think from a national perspective, we'd be really, really happy if overall we got back down to the 5.5% to 6% level that Iowa and Des Moines are at currently. Not nearly the spike back up, and overall a much healthier employment situation here in the great state of Iowa. Next, I'd like to talk a little bit about consumer confidence. Why does it matter? Why would we want to talk about consumer confidence? 2/3 of the U.S. economy comes from consumer spending. Is anyone surprised in the room, by show of hands, is anyone surprised at what we see in terms of the trend line downturn related to consumer confidence that's depicted on the slide? I ask that because it doesn't surprise me at all. One should have expected a much lower level of consumer confidence given what we've observed. Here's a little bit about what we've observed. We had a severe recession that lasted about 18 months, running from year-end 2007 through about the middle of 2009. So when you see the steep decline in consumer confidence, that's attached directly to the recessionary period that we entered in. Combine that with the fact that unemployment doubled. The rate of unemployment almost doubled from mid-2007 to mid-2009. So you have those two factors coming into play to weigh heavy on consumer confidence. The third factor, which is my favorite factor, I'll call the wealth factor. From mid-2007 to mid-2009, U.S. household wealth decreased $16 trillion. $16 trillion is a lot of money, and it's a lot of wealth to take out of our economy. Where did the $16 trillion come from? It was split about half and half from two sources that I think you could all relate to and understand. The first being home price devaluation. We had a lot of equity buildup that generated wealth that people were using to spend and promote consumer spending throughout the economy. So we had home price devaluation that basically sucked $8 trillion worth of wealth out of the economy. The second factor that affected me, and it may have affected you as well to varying degrees, would be the decline of the financial markets from 2007 to 2009. That was accounted for about $8 trillion worth of decrease as well. So that's a total of $16 trillion. Now, since 2009, the financial markets have recovered, so that overall, the wealth deficit from 2007 only stands at $8 trillion or $8+ trillion. The piece that relates specifically to home price devaluation. I'm not sure about you personally. I know I took a hit in 2007 to 9 from the financial market downturn in my pension, my 401k, my investments, and I didn't make it all the way back. So I'm kind of feeling like I'm on the short end of the stick there, but overall, wealth down. So those three factors, bottom line, I think it's going to be a long road to hoe in terms of upward and onward restoration of higher levels of consumer confidence. I say that in spite of the fact that we did post a higher, if it were up there, I would be pointing to our highest readings for about a year now. Was consumer confidence popped up to 71. That was released earlier this week. Mortgage interest rates. There we go. Mortgage street rates have rallied to record lows. No surprise to anyone in this room, I'm sure. They've been at record lows probably for the last month now, but ever since the financial crisis and the recessionary periods that begun back in the 2007 and 2008 era, mortgage interest rates have continued to rally lower and lower and lower. As many of you know, the Fed has taken a number of actions or steps to promote the rally in mortgages. I think it's clearly evident that they have an agenda with the intent to drive and keep long-term interest rates at a low level for as long as necessary. What actions have they taken? Some of you are probably familiar with quantitative easing, that reference. A lot of times it's abbreviated and you hear about QE1 and QE2, which were announced and implemented back in 2009 and 10, involved the purchases by the Fed of treasuries and mortgage-backed securities. Then you had option twist. It's currently underway. Bottom line is it's more purchases of treasuries and mortgage-backed securities. You have a lot of discussion about a possible QE3. It's been in the news a lot of late. So another Fed action that could be taken that would, again, serve the purpose of keeping longer-term interest rates lower. The rumors surrounding whether or not QE3 is likely depends on the latest economic release and how that's been digested and interpreted by the Federal Reserve and others. Targeted Fed funds rate was above 5% back in 2007. It's been managed lower and now is under 0.25%. Fed's become very transparent. They're now providing forward guidance. Now they're telling us that for 3 years out into the future, they're going to keep short-term rates very, very low. So all of those actions clearly with one intent and purpose in mind, to keep long-term interest rates lower. I would say that so that I think it should be clear to this group that they've demonstrated that's their plan of attack. So you should expect that's pretty much the track that they're going to stay on as long as they determine that it's needed or necessary. So it's that last little phrase that I think could be interpreted differently by different people. I think I may think of that in one sense. The Fed may think of it another. You may interpret it in a different way. So there's probably a lot of disagreement around, what would be needed and necessary. But clearly, they're going to have a watchful eye and they'll be taking actions if and when needed. Housing affordability, highest on record, and that would be true regardless of whether or not you're talking about for the United States, Iowa, or Des Moines. What is housing affordability? It's a function of income, home prices, and interest rates. Basically, for your income level, how much house can you afford? That's kind of the general gist of the index. Given what all of us know about income and home prices, I think it's fair to say, by process of elimination, it's easy to figure out that interest rates is the key driver in terms of why we're at record levels of housing affordability. This depicts the power of interest rates in terms of overall housing affordability. This is going to be my second Be Thankful You Live in Iowa, because Iowa and Des Moines are actually the higher trend lines of housing affordability. I was so intrigued by this graph that I actually had the folks draw the line between the peak record U.S. affordability index level and how that compared to Iowa and Des Moines over quite a period of time, over a couple of decades. And what's interesting to note is that the affordability index in Iowa and Des Moines has been pretty much at this level for a long, long time. Whereas on a national basis, they're just now getting to a level that is on a parallel path with that. So again, by comparison, much, much better situation that we're dealing with in the Iowa and Des Moines area. So that's basically the coverage I was giving you on the economic front. Moving on to the mortgage market, I'm going to spend a couple minutes talking about the regulatory environment, talk a little bit about credit and collateral constraints, and a little bit about product trends that we see being originated in the marketplace today. After the financial crisis of 2007, the financial markets were clearly in need of better regulation. The response to this came in the form of the Dodd-Frank legislation that was approved and enacted into law in the third quarter of 2010. Dodd-Frank got its name because it was sponsored by Senator Chris Dodd and Congressman Barney Frank. The law outlined 400 plus rules and was outlined in 848 pages. 848 pages. I haven't personally read the 840 pages. I think I only know one person who may have read 848 pages of the Dodd-Frank. I brought her with me today. I'm not going to put her on the spot, but I believe I've got one person who's read Dodd-Frank. By way of comparison, Glass-Steagall. So if you remember back, you've read in the history books about the stock market crash of the 1930s and the Glass-Steagall Act that was put into law at that time to address that financial crisis. 37 pages long. So on the one hand, our response now to the financial crisis, 848 pages. You know, back 8 decades ago, it was 37 pages. Again, the legislation was well intended and aimed at improving consumer protection. So done for all the right reasons. I would say, if you look at just the timeline presentation, the greatest majority of Dodd-Frank rulemaking that's due should have already been enacted in place. We've already missed the deadline and we're behind the 8 ball on that. This is one of my favorite slides. Dodd-Frank also contains a plethora of new government powers and oversight agencies. Not to spend a lot of time with this, but it's just to give you a feel for the complexity that's been introduced in terms of the landscape of regulatory oversight. A lot of complexity. With complexity comes a lot of cost. Now we're going to talk for a couple of minutes about credit, collateral, and product trends. No surprise to this group, mortgage credit remains very tight. If you measure credit in terms of the FICO score distribution or FICO scores attached to the loans that are being originated, by way of comparison, back in the 2006 era, which is probably the loosest credit era in our history, you would see that about 45% of loans originated had credit scores less than 700. Compare and contrast that with today, where we're sitting at about 20%. So over a halving of the percentage of businesses being done at that level of FICO. In terms of average FICOs, we've seen about a 40 to 80 point increase in terms of average FICOs when you compare 2007 to 2011, and you see it presented across the various agencies, Fannie, Freddie, and Ginnie. In either count, you see that the credit box has tightened. What's occurring in terms of negative equity or collateral constraint, as I like to talk about it? 25% of homeowners with a mortgage in the United States are underwater. Underwater, negative equity. They owe more on their home than their home is worth. That's primarily driven out of the sand states, Florida, Nevada, Arizona, as lead contributors to that. But the bottom line is those that are collaterally constrained have limited opportunities to participate in the housing market. They don't have the same options as others. They're basically totally eliminated from any and all move-up opportunities. Here's another, be thankful you live in Iowa, where we have less than 10% of homeowners in the state with a mortgage that are in a negative equity situation. Interesting comparison of the loosest credit era of 2006 to 2011. You can see in 2011, most recently, almost 90% of what's being originated today is in the form of conventional conforming or FHA VA production that's being delivered into Fannie, Freddie, and Ginnie. Compare that back to 2006, where you only had 36% of that same business being done. It's really amazing to reflect on the fact that 63% of what was being originated in 2006, 81% of that business has really gone away or had to be transformed into either the conventional conforming or FHA VA origination product lines. So significant difference. What you see left is about 12% of jumbo or non-conforming production. and home equities that are going on balance sheet for many financial institutions. I think the average is probably split 10% on non-conforming and 2% on home equity. So now we've set the stage. Hopefully you have a little bit of background and perspective with regard to the economy and the mortgage market. Next we're going to move in and spend the next several minutes kind of walking through the housing market and what we see. The way the discussion is set up, we first start with all the bad news. So all the bad news involves home prices and the impact that foreclosures and distressed property sales is having on home prices. So we'll talk that through, get that behind us, and then move on to the rest of the discussion, which is all pretty much upbeat and positive in every regard. One of the biggest factors negatively impacting housing activity is home price devaluation. You see that clearly depicted here. On the left, you see a comparison of the U.S. to Iowa. On the right, you see the comparison to Des Moines. National home prices peaked in the second quarter of 2007, and they've been trending lower ever since. By way of comparison, here's another. Be thankful you live in Iowa, where the Iowa-Des Moines picture and trend line is not nearly so bad. Actually, it looks fairly stable, healthy, and I don't think anybody would really point at that and say we have a major issue. If you think that's a major issue, then you ought to be living in any of these states, because the housing bubble itself has had its greatest impact on some of our largest cities in some of those sand states of Florida, Nevada, and Arizona. So here you have depicted the comparison of Miami, Phoenix, and LA, the overall U.S. average, and how Des Moines in particular compares to that. Clearly you see we're lucky to be living here in Des Moines, where we really don't have that same degree of home price devaluation. Actually, if you look at the 2007 and 2008 era for Miami, Phoenix, and Las Vegas, I mean, you see their home prices were almost in free fall there for quite an extended period of time. They've got a long road to hoe still ahead of them. Foreclosures. Why are foreclosures important? Foreclosures have been a major storyline of late and a major contributor to home price devaluation. Foreclosures result in distressed property sales. In the fourth quarter of 2011, 1 in 4 home sales were distressed property sales. To the extent that foreclosures decline and distressed property sales decline, that's a much needed relief in terms of pricing pressures that are applied to home prices. So the sooner we can get to that point, the better off in terms of stabilizing home prices in a number of these problem areas. Be thankful you live in Iowa here. Iowa's overall foreclosure rate in 2011, at least the fourth quarter, was 2.8%, compares favorably to the U.S. average of 4.4%. I would also say that Iowa is lower than about 2/3 of all states in terms of foreclosure rates, but very significant problem or issue that we need to work through for a number of the depressed areas of the nation that have been most impacted by the home price devaluation to recover. So that's all the bad news. I'm going to set that bad news behind me now, and everything from this point on is really kind of upbeat and positive. Home ownership is alive and well. Since the recession, many have been predicting a decrease in home ownership rates. And I know read of many predictions over the last couple of years that said it was going to fall to, the low 60% or to high 50% levels. As you can see, nationally, 66%, that's comparable to 2000 or the turn of the century when we were about at the same ownership rate at that time. And for the 4 preceding decades, it actually compares favorably to where we were for the previous 40 years. Iowa, again, be thankful you live in Iowa. The home ownership rate at 70+%. I have to admit, I didn't even think this could be possible, and so I get this. What am I doing? I'm just presenting the information. The subject matter experts have, put all of the data together, and so they went back and confirmed that this graph is in fact correct, and that Iowa, in fact, has had a home ownership rate in excess of 70% for over 3 decades now. This morning, my team sent me a note and said that As of the last reading for homeownership, Iowa actually is ranked fourth, the fourth highest state in terms of homeownership. So definitely strength in the state of Iowa. Next, we're looking at a month-to-month comparison of home sales, comparing U.S. to Des Moines. This is all just from a relative perspective. The scales are adjusted. But as you can see, just from a relative perspective, the home sale changes by month pretty much track very closely, and that's before, during, and after the first-time homebuyer tax credit of the 2009-10 era, and that's all the way through the entire interest rate rally period that we've experienced since the financial crisis in 2007. First-time homebuyers, we do see the elevation in first-time home buyers as a percentage of total home buyers as a result of the tax credit program that was in place in 2009 and 10. During that era, first-time home buyers comprised 40 to 50% of total home buyers. Since that time, we've stabilized at or about 30 to 35%. Still a very good level and a good run rate for first-time home buyers. U.S. home sales by month, got some good news here. On a national front, on a monthly basis, year-over-year increases for 7 consecutive months. You see that depicted in the highlight box to the right. If you look at the highlight box in the middle, you can see just the calendar year comparisons for home sales, and you can see that 2011 exceeded 2010. And what's significant about that? Well, it's really significant because 2010 benefited from the first-time homebuyers tax credit program. So you see the left side of the slide really highlights the comparative benefit in 2010 from the first-time homebuyers tax credit program. So in spite of that year-over-year comparative difference, year-over-year U.S. up. Next slide is the same type presentation for Des Moines. All of the messaging is exactly the same, so I won't go through it all in detail, but again, the exact same highlights, 7 consecutive months of monthly year-over-year sales increases, year-over-year 11 stronger than 10, and that's in spite of the benefit in 10 from the first-time homebuyer tax credit. 2 key measures of housing strength are housing inventories and months supply. Housing inventories came in, the last reading was, I believe it was 2.3 million units, but it was at its lowest level since October of 2002. The month's supply came in at or about 6 months. That's at its lowest level since 2006. So both of them have been trending very positively for the last 18 months, and I think it's probably the biggest indicator of what's ahead in terms of the housing market and the opportunity that we currently have. That we just kind of talked through, given the fact we're looking at monthly year-over-year sales increases, we're looking at housing inventories at record lows, month supply at record lows. It shouldn't come as a surprise that home builder optimism has gone through the roof, has spiked dramatically. If you look at the National Association of Home Builders Index, it's up 40% over the last 6 months. So a lot of positive things going on there that's calling for a very solid 2012 outlook in that space. We've made it to the end of prepared comments. In conclusion, the worst is behind us. Most indicators have turned positive and point to near-term improvement. Iowa, in particular, is on very solid ground, and prospects in 2012 look very good. That's the prepared comments. I did want to pause just for a second and give a quick thanks to the team members that actually were responsible for putting together all of the presentation materials and did all the research and everything. Deb Keene, Julie Jewell, and Rebecca Keys, thanks for your effort and contribution to the meeting in that regard.